Welcome back to Macro Shock. I'm your host, Dave, and today we're diving deep into a topic that has been a relentless source of volatility and uncertainty for years, the U.S. China trade relationship. Just when we thought we were perpetually locked in a game of tariff chicken, we got a glimmer of hope. But is it real or just another head fake? The market is pricing in a significant shift, and if you're not paying attention, you could be left behind. The big news breaking this week revolves around recent high-level talks between the U.S. and China. While the details remain somewhat murky, the overarching sentiment is one of de-escalation, at least for now. Our sources indicate that the U.S. effectively blinked in some key areas, realizing it wasn't in a strong negotiating position on all fronts. China, in turn, seems to have pulled back on some of its more destabilizing threats, specifically around rare earth exports. Former Treasury Secretary Larry Summers is quoted as saying, "We don't have an escalation, and the reason is the U.S. recognized its weaker stance." We're seeing an asymmetric response. China is diligently working to reduce its dependence on the U.S., while America appears to be focused on shorter-term fixes. Importantly, President Trump confirmed plans to travel to China in April for further talks with President Xi, who has agreed to a return trip later. This suggests a pathway for ongoing dialogue, however rocky. Key issues like technology integration, particularly around advanced chips, and national security decoupling remain unresolved. There was even a moment when the market went breathless over Nvidia's Blackwell chips possibly being on the table, only for it to be walked back. It's clear that while the immediate crisis has been averted, the deeper, more complex issues from the original 2017 trade war are evolving into challenges around national security and supply chain resilience. The conversation specifically highlighted a deal for China to buy 12 million tons of soybeans for the rest of the year, increasing to 25 million annually through 2028, a significant win for American farmers, though its longevity is tied to U.S. actions. Now, let's get to the critical part. What does this mean for your portfolio? To get a real-time pulse on market sentiment, I went straight to Polymarket, the leading prediction market platform. As of today, October 31, 2025, the market for U.S. tariff rate on China on November 12, 2025 shows a staggering 92% probability that the tariff rate will be less than 25%. Furthermore, the market for a U.S. ex-China tariff agreement by November 10 has already resolved to yes, signaling that an official agreement on tariffs was indeed reached. This tells us that the smart money is overwhelmingly betting on continued de-escalation and a relatively stable, lower tariff environment in the immediate future. Based on this strong signal, coupled with the underlying complexities discussed in the news, here are my 3 scenarios. Base case: controlled de-escalation and stabilized trade, probability 85%. Under this scenario, the broader market, particularly the S&P 500 and Nasdaq, would likely continue their upward trajectory. The removal of immediate tariff threats and the promise of continued dialogue reduce a major source of systemic risk, allowing investor confidence to build. We could see a sustained rally as capital flows back into growth assets. Sector impact: technology. This sector breathes a sigh of relief. Chip makers like Nvidia, NVDA, which saw volatility around the Blackwell chip discussions, would benefit as clarity emerges on acceptable levels of integration and export controls stabilize. The easing of restrictions, even temporarily, is a positive for supply chains. Agriculture. Farmers would see a boost, specifically those tied to soybean exports. Companies like Archer-Daniels-Midland, ADM, or other agricultural giants could see increased demand and stable pricing. Industrials. Sectors reliant on global supply chains and stable trade flows, such as manufacturing and industrial equipment, would also perform well. Think companies like Caterpillar, CAT. Stock impact. NVDA continues its strong performance. ADM sees solid fundamentals, and CAT benefits from renewed global trade confidence. Bull case: significant breakthrough and long-term deal, probability 10%. In this less likely but highly impactful scenario, President Trump's April visit to China yields a comprehensive, long-term trade and technology agreement that addresses core structural issues. This would ignite a massive risk-on rally, potentially pushing the S&P 500 to new all-time highs and significantly boosting the Nasdaq. Sector impact. Technology. A breakthrough on tech integration and IP protection would unlock massive growth. Companies like Qualcomm, QCOM, and other semiconductor firms would see a surge. Consumer discretionary. Reduced trade friction could lower import costs, benefiting retailers and consumer brands like Apple, which has significant manufacturing ties to China. Financials. Increased global trade and economic certainty would benefit large multinational banks such as JP Chase, JPM, through improved lending and investment activity. Stock impact. NVDA, QCOM, AAPL, and JPM would experience substantial upside, driven by the strong positive sentiment and tangible economic benefits of a lasting deal. Bear case. Re-escalation and renewed trade war. Probability 5%. Despite the current de-escalation, a sudden breakdown in future talks or a new unexpected tariff hike would send shockwaves through the market. The S&P 500 and Nasdaq would face significant selling pressure, potentially retesting previous lows. Volatility would spike and investor confidence would evaporate. Sector impact. Technology. This sector would be hit hardest, particularly semiconductor companies, as export controls tighten and supply chains fracture. Nvidia, NVDA, would see severe downside pressure, and companies reliant on Chinese manufacturing or sales would suffer. Agriculture. Retaliatory tariffs on U.S. agricultural products, especially soybeans, would devastate farmers, impacting companies like Deere & Company, DE, due to reduced equipment sales. Materials/rare earths. While China temporarily pulled back on rare earth threats, a re-escalation could see them weaponize these exports again, severely impacting U.S. manufacturing that relies on these critical minerals. Stock impact. NVDA and DE would see sharp declines. Companies with high exposure to Chinese markets or complex supply chains would be particularly vulnerable. All right, so what am I doing in response to all this? Given the strong Polymarket signal for continued de-escalation and lower tariffs, my personal take is cautious optimism, which translates to a hold with a leaning towards opportunistic buying on dips. I believe the market is correctly pricing in a temporary reprieve, but the underlying rocky road ahead means we can't get complacent. Now let's look at the charts, specifically the SPY, the ETF tracking the S&P 500. As the technical analysis tells us, SPY is currently in a clear uptrend, which is great news. However, we've hit a major resistance level right around the 690 mark. This tells me that while the bulls are in control, there's a significant ceiling to break through. If our base case plays out, I'd be watching for a decisive break above 690, which could signal further upside momentum. On the flip side, we have major support levels at 660 and then further down at 620. If we see any unexpected negative headlines or a breakdown in the perceived de-escalation, I'd be watching $660 very closely. A breach of that level could signal a pullback, and if $620 gives way, that's where my bear case starts looking much more probable. So I'm holding my core positions, but I'm ready to add if we see a significant dip to those support levels, assuming the macro picture doesn't fundamentally change. I'm also keeping a close eye on individual stocks within the tech and agriculture sectors for signs of strength or weakness against these broader movements. What do you think about this U.S. China situation? Are we truly de-escalating, or is this just a temporary truce? Let me know your thoughts and your own trading strategies in the comments below. And if you're getting value from this analysis, hit that subscribe button and ring the notification bell so you don't miss our next macro shock episode. Remember, this is not financial advice, just my analysis and perspective as a retail investor. Always do your own thorough research and consult with a financial professional before making any investment decisions. Investing in the markets carries inherent risks.